Ian Charteris, welcome to Sept Talk TV. Let's start by hearing a little bit about your personal background and the funds that you're responsible for.
Well, I was a stockbroker for many years. I was a member of the London Stock Exchange up until 1986 when Big Bang occurred and personal memberships effectively ended, and then moved on to some proprietary trading and then on to fund management, and bought Charteris in 2002. So we've had it nearly 10 years now. And we've launched 3 funds. We run a gilt fund, we run an equity fund, and we run a gold fund.
Is this a good time to be investing in equities?
I think it's an excellent time. Equities now are at their cheapest relative to gilts for 50 years. The dividend yields on equities are now higher than they are on gilts, which is very unusual for most of the last 30 or 40 years. Equity yields have been lower than gilt yields, they're now higher. Companies, especially the big multinational companies, are in really great shape. They've got lots of cash, very cash rich, and equities, if for anyone who's prepared to take a medium to long term view, and by that I mean sort of 2 to 3 year view plus, I think equities could be an absolutely outstanding time to buy them. As Warren Buffett said, you should be greedy when others are fearful, and you should be fearful when others are greedy. There's a lot of fear around at the moment, which means there's a lot of bargains around at the moment.
What are the key features of the elite Charteris Premium Income Fund? What makes it stand out from other funds?
It's only invests in FTSE 100 companies, so anyone who invests in this fund knows that their money is only going into the big blue chip stocks. And then it also seeks to supplement the income from those stocks by a covered call option strategy, which means that the dividend yield on the fund for 2011 is 6.8%. So you're only investing in FTSE 100 stocks, you're not investing in high risk, low quality companies that no one's ever heard of. These are all blue chip companies, but their fund pays a 6.8% dividend yield this year.
What positions have you taken over the past 2 years that differentiates you from other fund managers?
I think we took a view in 2008 that effectively the Western world was going into quite long-term serious relative decline against the emerging markets, especially in Asia, and that all the economic growth was going to come through countries associated with China, and that's where all the growth was going to be, and that companies within the FTSE 100 that were focused on trading with that area of the world were going to do much better than the purely UK-centric companies, such as retailers and UK property companies, which we felt were going to struggle. So we felt all the growth was going to come from the emerging and Asian world. We've had that view for years, ever since we took the fund over in 2008, and that's the main reason the fund has outperformed the FTSE so much since we took it over.
Does selling covered call options act to increase or decrease risk?
Selling covered call options actually decreases the risk and it decreases the volatility for the period that the option's in place. Because what you're doing, you're cushioning the downside and capping the upside by the amount of the option premium that you receive. So I'll give you an example. Say the fund owns 1 million Vodafone. Vodafone shares are £1.75. We could sell a 3-month call option for about 8 pence. That 8 pence goes straight into the dividend account, which is why the fund yields 6.8% against the FTSE yield of about 3%. And the time that option is in place, if the shares go down, the 8p acts as a cushion against the fall. Obviously, if the shares rise quite sharply, you miss out on the profit, because for the 3 months that the option's in place, you've sold that profit to someone else. And that's the price you pay to get the extra income from the fund. But that, you don't actually lose money, you just miss out on some gains.
Who's the custodian of the elite Charteris Premium Income Fund?
The elite, for both our funds that we have with Way, the gold fund and the equity fund, the custodian is State Street Bank, which is the largest custodian bank in the world.
Looking at the underlying holdings in the equity fund, do you have any bias to any particular area?
Yes, as we discussed, the fund has outperformed the FTSE since we took it over by about 20%. And the reason for that outperformance is that we've concentrated the stock selection process in basically multinational companies that earn a vast chunk of their money outside the UK, and we're hardly any exposure to what we would call UK-centric stocks. And what's happened over the last 3 years, as the emerging markets have taken off, and China and India are growing at 8, 9, 10% a year, while the UK and the US and France hardly grows at all, is that the companies that earn most of their money overseas have massively outperformed the companies that are reliant on the UK economy. And that's the reason for the fund outperformance.
Now, moving on to gold, tell us a little about the style you adopt in running the Way Charteris Gold Fund.
Okay, well, we launched this fund about 18 months ago now, and it's been very successful. The fund can invest in either gold bullion or gold equities, gold mining companies. At the moment, we have chosen to invest 100% of the fund in gold equities because we believe they offer superior investment prospects to actual bullion itself. Now, those advantages are that the shares pay dividends, the shares can make exploration, discoveries of gold, new gold, and the shares can be subject to takeover activity. Now, if you just purely buy gold bullion, you miss out on all these potential possibilities to make money. So we think that the shares will actually outperform the bullion price over the long period of time. The fund itself, 70% of the fund is invested in blue chip gold mining stocks with market capitalizations in excess of $2 billion, and the remaining 30% is in stocks between $500 million and $1.5 billion in market cap. We don't finance early stage exploration. We're only interested in investing in gold companies that have gold, produce profits, and hopefully pay some dividends as well.
Why do you think gold shares haven't done as well as gold bullion this year?
This has only really happened in the last month, in that a month ago gold was $1,500 an ounce, and within a month it's gone to $1,900 an ounce. And the shares normally lag the price, the shares lag the price, but they tend to go up more when they finally catch up. And it's happened so quickly. Since the fund was launched, the fund has actually outperformed the gold share index by about 20% and has more or less kept price with the price of bullion, even though it's lagged in the last month. So if we then catch up with what we expect to happen is the shares will now have a period of catching up to do. We expect the fund to retain its outperformance over the bullion price since the fund was launched.
What are gold mining companies going to do with the huge profits that they're now generating?
We actually think gold mining companies are the cheapest asset on the planet right now. They're making so much money that a lot of these companies just don't know what to do. That's why we think the shares offer better value than just purely playing the bullion price. The average gold mining company digs gold out the ground at about $500 an ounce, and they're currently selling that gold for $1,900 an ounce. The profits they're making are huge. Equally, in silver, it's even more extreme. The average silver mine company digs silver out the ground at about $5 or $6 an ounce, and they're selling silver for $42 an ounce. Now, no other industry in the world is making profits like this. And we think it will ultimately lead to a feed-in frenzy of takeovers, where all the big companies are going to start taking over the medium-sized companies, and the medium-sized companies are going to start taking over the small ones. So if the investors don't buy these companies, the industry will.
What type of retail investor should be considering using the Charteris Premium Income Fund and the Way Charteris Gold Fund? Okay,
well, first of all, the Charteris Premium Income Fund, if you want an investment in blue chip equities, which, as we mentioned before, equities are now at their cheapest level relative to UK gilts for 50 years. If you buy that argument and you decide you want to invest in blue chip equities rather than smaller companies, which carry more risk than the blue chips, but you want a decent dividend yield, this fund offers the combination of an investment in an asset class that's very, very cheap on historical terms, only invest in blue chip stocks, and this year paid a dividend yield of 6.8%. And secondly, the Way Charteris Gold Fund, as we've mentioned, we think that gold mining company shares are now the cheapest asset on the planet. The companies are making so much money that ultimately this will have to be reflected in much higher share prices. And if investors bulk are buying the shares at the moment, the industry will buy them. You're just going to see a rash of takeovers.
Ian Williams from Charteris, thank you for talking to Sept TV.
Thank you, it's my pleasure.